Welcome to Value Vest Daily. Let's dive right into today's deep dive explainer. We are breaking down our latest in-house research on a massive piece of legislation that just advanced in Washington. It's called the Digital Asset Market Clarity Act, or, the Clarity Act for short. And let me tell you, this is definitely not just another boring policy update. In our research, we've identified this as a fundamental, foundational game changer. We're talking literal 10x potential for the entire digital asset space over the coming cycle. So our goal with this explainer is to objectively unpack our thesis, really get into the actual technical and legal mechanics of the bill, and understand exactly why we believe this changes absolutely everything for institutional adoption and on-chain metrics.
When we see news drops characterized by dramatic historic weight, the classic golden gavel, exploding coins, massive green bull market arrows, it really captures the exact psychological shift happening right now. For years, the crypto market has operated under this massive, heavy cloud of existential dread, right? Will the US outright ban it? Will they tax it into oblivion? Are software developers literally going to go to jail? This fear has kept trillions, yes, trillions of dollars of traditional finance capital locked safely on the sidelines. The advancement of this bill represents a potential breaking of that dam. It's a historic market-moving catalyst because it fundamentally shifts the narrative from just basic survival to full-blown institutional integration and growth.
To truly understand this argument, here's our roadmap for today. First, the Clarity Act breakthrough. Second, the new regulatory boundaries. Third, the stablecoin compromise. Fourth, our value and momentum thesis. And finally, number 5, the remaining regulatory risks. Let's jump in.
Section 1. The Clarity Act breakthrough.
Okay, so the absolutely crucial point anchoring our entire thesis is a hard data point from May 14th, 2026. On that exact day, the Senate Banking Committee voted 15-9 to advance the Clarity Act after a seriously grueling markup session. We really need to pause and look at exactly why this is statistically so significant. The Senate Banking Committee is, traditionally, one of the most conservative, risk-averse legislative bodies in Washington. Getting a 15-9 vote, that means multiple members actively cross party lines. It shows a highly solid, bipartisan push. Statistically speaking, complex 309-page financial overhaul bills do not even make it to a markup session without heavy, backroom consensus already locked in. This 15-9 vote is the physical data point that triggered institutional algorithms everywhere and signaled to the broader market that serious, structural change is actually happening.
Moving right along to Section 2, new regulatory boundaries.
For years, the SEC has essentially been playing whack-a-mole with the crypto industry, relying on arbitrary lawsuits rather than, clear written rules. The Clarity Act aims to fix that once and for all by drawing a firm line in the sand based on actual computer science and technology. On one side, you have the Commodity Futures Trading Commission, the CFTC. They officially get oversight of digital commodities, explicitly naming networks like Bitcoin and Solana. Let's think about the technology here. A digital commodity like Bitcoin uses proof-of-work consensus. That means thousands of independent computers globally secure the network. There's no central issuer, no CEO, no marketing department. It is pure decentralized computing power. On the other side, the SEC keeps its jurisdiction over actual securities. Those are tokens that act technologically like traditional investment contracts, where a central team holds the keys and promises future profits. By formally recognizing this fundamental technological difference, the bill finally ends this era of regulation by enforcement and gives exchanges the clear scientific rules of the road they have been begging for. Building heavily on those new boundaries, there are some massive legislative wins baked into the bill that specifically protect the underlying technology. First up, digital commodities receive safe harbor treatment. This shields them from restrictive classifications while their networks achieve sufficient decentralization over time. Second, and this is absolutely huge, developers building in decentralized finance, or DeFi, are explicitly protected from liability. Mechanically, what is DeFi? It's simply autonomous, self-executing code, smart contracts deployed on a blockchain. In the past, regulators tried to treat the software developers who wrote this open-source code as if they were actual bank executives running a centralized business. That was technologically and legally completely flawed. The Clarity Act fixes this critical problem by definitively stating that writing code is not the same as operating a financial exchange. This safe harbor is going to completely unchain software innovation on high-throughput networks.
Which brings us to Section 3, the stablecoin compromise.
Now, this right here is what our research identifies as the major negotiation point that actually got the bill passed through committee. Technologically, stablecoins like USDC are fiat-backed smart contracts. They're digital tokens on a blockchain backed one-to-one by actual dollars sitting in a vault. Traditional banks fought incredibly hard against these stablecoins paying passive interest just for holding the asset in a digital wallet. Why? Because they feared a massive drain of their traditional deposits. And you know what? The banks won that fight. The bill officially bans bank-like passive interest. But the brilliant compromise is that activity-based rewards are explicitly allowed. On the blockchain, this physically works by rewarding users who contribute computing power, provide liquidity to trading pools, or process network transfers. The yield comes from network utility and cryptography, not a bank's lending margin. It's a huge win-win because companies like Coinbase and Circle can continue to innovate with USDC without stepping on the toes of the traditional banking lobby.
And this isn't just theoretical stuff. The data points clearly show that even with this compromise, banning passive holding yields, you can still earn a 3 to 9% annual percentage yield in compliant DeFi protocols like Aave and Morpho. Let's really look at the science and data of how that works. These are decentralized liquidity protocols. They generate yield not through a corporate entity taking your money and investing it, but through algorithmic over-collateralized lending. A borrower has to lock up, say, $150 worth of Bitcoin in a smart contract just to borrow $100 of USDC. The smart contract automatically enforces the rules and liquidates the collateral if it drops in value, all based on supply and demand algorithms. This ensures the system is always mathematically solvent without a single human middleman. Because these are mathematically transparent, activity-linked products, they fit absolutely perfectly within the new legal framework. The bill channels this data-driven innovation rather than trying to kill it.
Let's move into Section 4, the value and momentum thesis.
Here is where we unpack our highly enthusiastic predictions here at ValueVest Daily. Our core logic is very simple. Regulatory clarity equals a flood of institutional money. We draw a direct, undeniable historical parallel to the massive inflows we saw right after the Bitcoin spot ETF approvals. Let's look at the historical data for a second. Within just months of those ETF approvals, we saw over $15 billion in net inflows. That pushed Bitcoin's market cap to historic highs and acted as a massive multiplier for the entire ecosystem. We argue that the Clarity Act is structurally even bigger than the ETFs. Why? Because it locks in U.S. leadership and compliant infrastructure across the entire digital asset board, not just Bitcoin. By providing legal certainty to sovereign wealth funds, pension funds, and major asset managers, this paves the runway for what we project to be trillions in new, legally compliant capital entering the space over the next 5 years.
Our report specifically names 3 assets as structural winners here. For Circle, the stablecoin compromise locks in the rules for USDC, leading to exploding adoption in global payments. For Solana, its status as a high-speed chain combined with those new DeFi safe harbor protections is literal rocket fuel for on-chain developer activity. But let's take our time and really deep dive into Coinbase, ticker symbol COIN. When evaluating an individual stock like this, we always have to look at the discounted cash flow, or DCF model. Clearer rules mean a massive surge in institutional trading volume and custody services. In our DCF model, we project Coinbase's free cash flow over the next 5 years based on this anticipated volume spike. By removing the severe regulatory risk overhang, we significantly lower the discount rate applied to those future cash flows. The math is incredibly compelling. Lowering the discount rate, while simultaneously projecting a 30 to 40% compounded annual growth rate in institutional revenue, makes the present value of Coinbase extremely attractive. Based on our DCF modeling of this new legislative environment, it signals a strong structural buy.
And we can just look at the immediate market reactions on May 14 to back up this momentum thesis. Let's take this data slowly because it's important. First, we saw Bitcoin holding incredibly strong near the $81,000 to $82,000 mark, showing robust baseline support despite broader macroeconomic pressures. Second, look at Coinbase. Coin stock popped 8 to 9% intraday just on the news of the committee advancing the bill. The market instantly started pricing in that future cash flow we just talked about in our DCF model. And finally, Circle, ticker CRCL. They were already having an incredible 2026, up 56 to 68% year-to-date even before this vote happened. Why? Because the market was already seeing massive global adoption of the USDC stablecoin as a safe haven in emerging markets. This specific Clarity Act news acted as a secondary catalyst, surging it all over again. For our analysis, this real-time price action is basically mathematical proof that the market is rapidly pricing in the total end of regulatory uncertainty.
Finally, Section 5, remaining regulatory risks.
Look, despite all the hype and the 10x language we've been using, it is absolutely vital to objectively map out the actual reality of the legislative process. The Clarity Act is not law yet, not even close. It still needs to secure 60 votes for full Senate approval to overcome a potential filibuster, which, let's be honest, is a very high hurdle in a divided Congress. After that, it has to go through House reconciliation. Let me briefly explain what that entails structurally. If the House passes a slightly different version of the bill than the Senate, members from both chambers have to form a conference committee to literally line edit and merge the two competing texts into one unified document. This reconciliation phase is a brutal, high-stakes negotiation. Critical crypto protections could easily be watered down or traded away for completely unrelated political favors. Finally, it requires a presidential signature. So while we argue the institutional momentum is quote-unquote unstoppable, these are significant systemic structural hurdles where the bill could still be altered, delayed, or stalled completely.
Which brings us to a very important point here on the explainer. Please remember, while we are providing deep dive research and detailed financial modeling today, this is not financial or tax advice. Crypto and equities are highly volatile, and the legislative landscape can literally change overnight. Always do your own research. We are simply laying out our internal analysis and showing you the science, the data, and how we are connecting legislative developments to our broader market theories. So the ultimate question we want to leave you with today is this. Will the regulatory boundaries established by the Clarity Act actually trigger the institutional flood that our models predict? Or are those remaining legislative hurdles just too steep? It is a fascinating structural shift to watch unfold. Please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing, please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities. See you next time.